The IRS has just released their 2026 tax brackets, and what you're going to see in this new tax bracket is you will pay less tax on more income. Also, when we combine this with the One Big Beautiful Bill and a lot of the provisions that will save you in 2026, you're going to see how you are going to be paying less tax despite making more money. All right, now let's look at the bracket here for 2026. Now, as you can see here, the top bracket is at 37%. Now, the One Big Beautiful Bill, Trump had said he was willing to go to a higher bracket of 39% on anyone making $1 million or more. That didn't happen. That didn't go into the bill. The final bill that was put into effect, 37%. The lowest rate here is 10%. Now, as you can see in this bracket here, there's a couple jumps where it just goes 2%, like 10 to 12, but there's a couple instances where it jumps really high, like here, 12 to 22%. This is if you're married filing joint, making over 100 grand a year. But then the next jump is just another 2%. Then you go again at a really big jump here of 8%. So there's two areas in the tax bracket here, right in these two buckets here. And I'm looking at married filing joint here. You can look at the single column, but married filing joint, 100K a year. That's when you're going to start jumping up into the 22% bracket on anything over 100K. And again, you jump again once you're over 400K from 24% to 32%, you go up another 8%. Now, the important point to understand in our tax system and in these tax brackets is you do not have one tax rate for all your income. You have a tax bracket each time your income goes up that applies to that layer of income. For example, if you make 150 grand a year, married filing joint, you might look at this and say, oh, I'm right here, 22% rate, because I'm between 100 and 200 grand, married filing joint, I make 150K. No, that is not how that works. You will not pay 22% on 150 grand of income. Instead, you're paying 22% only on the income between 100 grand and 211,000 grand. So only on that 50,000 over 100 grand. But on that income between 24,000 and 100,000 here, you're at 12%, and then again, 0 up to about 25K there, you're only at a 10% rate. So let's go over how this works, and I want to layer on how deductions affect this, and then again, how some tax credits work, some of the new stuff out of the One Big Beautiful Bill. All right, now let's just run some numbers here. Let's say you make 150K a year, married filing joint. On your first 25K of income here, you're paying at a 10% rate, $2,500. The next 75,000 up to 100 grand, you're at a 12% bracket on that layer of income. That's 9,000. So on your first 100 grand, you have a total of 11,500. If you think about that, on 100 grand, that's 11.5%. That's your effective tax rate. What is the tax rate I'm paying on my taxable income? Now, when we go over 100 grand here, this is the married filing joint for 2026. Now here I've got up to 150 grand as the example. So on that next 50K, I'm in the 22% bracket. Now that next 50K cost me $11,000 in tax. Hey, sorry to cut in here. I just want to make sure you know of my law firm, KQS Lawyers, where we help clients across the country save on taxes, protect their assets, and plan their estates. Get over to kqslawyers.com to learn more. We'd love to be of assistance to you. Now back to the video. My first 100 grand was only 11,500 in tax, all right? So as you keep going up the income ladder, your rate goes up only for that bracket of income. Now, for very high income earners, married filing joint here, over 760 grand a year in annual income, everything over that is just at the max 37% rate. But everyone else, your kind of income and how you're taxed is layered through here. But I'm going to show you in this example how someone making 150 grand a year is not going to pay 22%. You're not going to be paying 11%. You'll actually pay 4.7% once you take into deductions that are greater under the One Big Beautiful Bill and some of the other tax credits available. So let's break down how someone making 150 grand a year is actually only going to pay 4.7% in tax. They are not doing crazy tax planning. This is regular, ordinary stuff a lot of Americans take advantage of on their tax return every year. All right, now what we're going to do in this example here is assume you have 2 kids. And what we need to do here is do the regular deductions that apply, whether you do standard deduction or itemized deduction. I'm going to do an easy example here so you can see how this bracket works. And then we're going to take into some very common tax credits that are going to reduce the tax that you owe. So deductions at first here reduce your taxable income. Credits offset tax that you owe. Okay, let's go through the example here. All right, now you get to take the standard deduction. The standard deduction in 2026, these are the updated numbers, is $32,200. Okay, that's for married filing joint. For single, it's $16,100. That is a deduction you get to take that reduces your taxable income immediately. All right, let's go over an example of someone making $150K a year, married with 2 kids. I'm going to show you why that marginal bracket that they have of 22% actually only comes down to a 4.7% effective tax rate doing regular things you're probably doing every year. And this is taking into account some of the stuff in the One Big Beautiful Bill and the updated numbers for 2026. So the first thing you need to understand is your number one deduction you can take is the standard deduction. Congress has basically said, hey, don't track all your deductions, all of your mortgage interest, your charitable contributions, your state and local tax. Just take the standard deduction of $32,200. So someone making $150K a year gets to reduce their taxable income down to $123,000, okay? I get a deduction immediately that reduces my taxable income down to $123,000. Well, we know I pay tax at 22%, that's the bracket I'm in, on income between 100 and 200K. I get 150K in this example here. So I've reduced my taxable income down $32,000. In other words, I'm not paying tax on 32 grand. So what's my savings? Depends on your tax rate. In this example here, that marginal bracket I'm at for this income is 22%, means I just saved with the standard deduction $7,084 in tax, okay? That's given to you as an automatic option. You can just check the box on your tax return. Now you might say, I actually have more deductions than the standard deduction. I want to itemize, okay? This is an option you have on your individual return. So let's go over someone who might itemize and how that would look. And you would do this if your total itemized deductions go over $32,000. Now here's some of the itemized deductions that you might take, very common. First, let's say you have mortgage interest and you paid $20,000 in mortgage interest for the year. That's an itemized deduction you get to take on your tax return. Next, let's say you gave 10 grand to charity, your church or other charitable organizations. That's also an itemized deduction. Next, let's say you had to pay $5,000 in state and local tax, either state income tax or property tax in your state. So let's say you had $5,000 of state and local income tax. That's another itemized deduction. So you can see here, I've got $35,000 of itemized deductions. That's more than the $32,000 standard deduction. So because of that, I'm going to itemize and take a $35,000 deduction here. Now let's add in some more deductions as well. Let's say that you put in $7,000 a year into a traditional IRA that year. There's another $7,000 deduction, reducing your taxable income. Let's say your spouse contribute to their 401k and put in $8,000 this year into their 401k as traditional dollars. That's another deduction, $8,000. So here, I've got up to $50,000 in deductions that's going to reduce my 150K of income, remember here, and I'm paying it a 22% rate, over 100K up to over 200K, but I had 150K of income. This is the example. So I get to reduce that. I get to add all this stuff up. These were the itemized. These are just additional deductions you get to take. So now I'm going to reduce this by 50K. So I really only have 100K of taxable income. So now what this means is I'm not paying tax on anything at 22%. Okay, that big jump where you go to 22%, I have no income over 100 grand. That 22% only applies to income over 100 grand. So now in this example, I'm only paying tax on the first two brackets. On the money I made from 0 to 24,000, let's just say 25 grand here. And then again, from 25 grand to 100. That's at 10% on that bucket, and that's 12% at that bucket. Now that is 11,500 in tax on 100K of income, right? It's a little bit of a blended rate here of 11.5%. That's actually what I'm paying here, okay, because it's two little buckets, but combined, my effective rate is only 11.5%, 11,500 in taxable income. All right, now we're not done yet, okay? We're at 11.5% tax that we need to pay. Now remember, we had 150K of taxable income. We took a lot of deductions there to get down to only 100,000 of taxable income. The next thing we do is we take tax credits. See, now we know what we're paying in tax. Now we know we've taken every deduction that we can. Now there's more you can take, by the way. I just give some examples of some common stuff here. But in this example here, we took every deduction we can. We owe 11,500 grand on 150 grand of income. And actually that comes out to 7.6% of an effective rate on my total income because that's on 150K. That's really what I make. I got to reduce it down to 100K. Now let's take the tax credits, okay? We owe 11,500. Well, we have two kids. The child tax credit in 2026 was extended and increased to $2,200 per kid. So that means I have a $4,400 tax credit that offsets the tax I owe. So I get to reduce the tax I owe by $4,400. Now we're only at $7,100 on $150K of income. That is a total tax rate at the end of the day of 4.7%. You went from being in what you thought was the 22% tax bracket down to only paying 4.7% at the end of the day because of how the marginal tax brackets work, because of deductions that you can take that every American's entitled to. We want to maximize those. There's more you could take. I just gave some examples there. And by using tax credits that reduces the tax owed. Now, this example here is why everyone likes to geek out on tax planning, because the name of the game here is thinking of every deduction you can get on your tax return that's going to reduce your taxable income, and it goes off the top. The highest tax bracket you're sitting in, that highest bucket, it reduces that one, which is the best benefit to you, right? So we're reducing our taxable income in that highest bracket that we have, pushing us down into a lower bracket on the other income we have remaining. And then after that, we want to pick up any tax credit possible. Again, more tax planning to reduce the tax that we end up owing. That's how you end up getting single-digit effective tax rates of what you're actually paying the IRS on your income. Now, there are so many tax deductions and strategies, particularly for any of you that are self-employed or investors. There's a lot of tax opportunity and planning where you can reduce the tax due and reduce the amount of tax that you're paying to the IRS and to the state. Now, in my law firm, KQS Lawyers, we work with clients across the country who are trying to save on taxes. We look at your last year's tax return. We go over your business or your investments and look at the tax planning opportunities so you can first get the deductions, take advantage of any credits, and at the end of the day, pay the lowest tax amount possible. Now, please subscribe to my channel. I've got a lot of information here on tax planning opportunities, how to protect your assets, how to use retirement accounts to grow and build wealth. I'm Matt Sorensen. We'll see you next time.